Most people think life insurance is just a safety net, but what if it could actually replace your family's income forever? We're not talking about a payout when you die. We're talking about a living, breathing financial engine running in the background while you sleep. The strategy getting quiet attention right now is something called infinite banking, and it's built around whole life or index universal life policies that accumulate cash value you can actually borrow against. Think of it less like insurance and more like a private bank you own one that grows tax advantaged and never asks for your credit score. Here's where it gets wild. The average American household spends somewhere around $40,000 to $50,000 a year on interest payments to banks, credit cards, and lenders. Money that just evaporates. What if you could recapture that interest and pay it back to yourself instead? The catalyst behind this movement isn't new figures, like Nelson Nash wrote about it decades ago, in a concept called becoming your own banker. And it's been quietly circulating in wealth circles ever since. But now, financial creators, real estate investors, and everyday families are dusting it off because traditional retirement accounts are looking shakier by the day. The optimism around these strategies peaked hard a few years back when low interest rates made everything look like a genius move. And now skeptics are sharpening their knives, saying the fees and surrender charges will eat you alive. But here's the honest truth. Both sides are right under the wrong conditions. And the difference between disaster and dynasty is almost entirely in the design of the policy. History shows us that poorly structured policies have absolutely wrecked people who trusted the wrong agent chasing commissions, and that trauma lives rent-free in financial discourse to this day. But a well-overfunded policy, one designed to minimize the insurance and maximize the cash value, behaves almost nothing like the dusty whole life policy your grandparents were sold in 1973. The pattern here fits a completely predictable cycle where sophisticated strategies trickle down from institutions to retail investors, get misunderstood, get abused, then get refined into something actually useful. Communities like Reddit's personal finance threads and private real estate masterminds are full of people successfully using these policies to fund rental property down payments and bridge loans with receipts. The biggest misconception you'll hear is that term insurance is always better because it's cheaper. And while that's true for pure death benefit coverage, it completely misses the point of what we're building here. Term is renting protection. Whole life done right is building an asset, and conflating the two is like saying a lease beats a mortgage because the monthly payment is lower. The practical lesson from every cycle of financial innovation is that the tool is almost never the problem. The behavior around the tool is. You want to be the person who overfunds the policy consistently for 5 to 10 years, borrows strategically, repays disciplined, and treats it like infrastructure, not a lottery ticket. Position size matters enormously here because you should never fund one of these policies at the expense of an emergency fund or employer match in a 401k. This is a layer in your strategy, not the whole foundation. The families who win with this approach commit a fixed, sustainable premium they could pay even in a bad year, then let compounding do the heavy lifting over decades. There's something almost philosophically satisfying about a strategy where the insurance company takes on the risk of market downturns in an index product. While you capture a floor with no losses, it's boring in the best possible way. Boring, consistent, and relentless is exactly how generational wealth actually gets built. Not through one brilliant trade, but through systems that survive your bad moods and bad markets. The irony is that the wealthiest families in America, the ones with multi-generational money, have held enormous cash value life insurance policies for over a century, while the middle class was told to buy term and invest the difference in volatile markets. You were handed a strategy designed for someone else's risk tolerance and told it was universal wisdom. Could this replace your family's income forever? If designed properly, funded consistently, and deployed strategically into income-producing assets, the cash value becomes a perpetual funding mechanism that outlives you and keeps working for the next generation. That's not a sales pitch, that's just compound interest with a tax wrapper and a death benefit attached. The comfort here is that, unlike the stock market, you don't need to be right about timing. You just need to be consistent because the policy grows regardless of whether the Fed raises rates or the market corrects 30% next quarter. Rational preparation always beats emotional prediction, and this strategy rewards patience over performance. Whether you're brand new to this concept or already halfway down the rabbit hole, check out our links in the description below. We can help you get started. Whether you're looking into real estate investing, home contracting work, or finding the right lenders to put this all together.